Hello, my name is Paul Roldan, principal and partner at AllGen Financial Advisors. And today I want to talk to you a little bit about ESOP, or Employee Stock Ownership Plans. An employee stock ownership plan, or ESOP for short, is typically a retirement plan that allows employees to buy stock of that company. Okay, so it is a retirement plan where you can contribute from your paycheck and use those dollars to buy shares of that particular company. So it helps diversify your retirement and feel more vested in whatever company you're working for, because you're actually saying, hey, I'm owning some of this company through my ESOP program. So a few mistakes that we see with ESOP participation come on two sides of the fence. One is when you're actually purchasing shares. We've seen people come in with too many shares. And how do you define too many? Well, it's prudent to have a diversified portfolio when investing, right? So you don't want to have too much of your investments exposed to one particular holding. And we've seen people that are very excited about the company they work for, which is great, but then they tend to over purchase relative to their investment portfolio, those shares. Now you're overexposed. Okay. So you have equity exposure to one company, which can be dangerous, especially in that situation, because if the economy turns poorly for that company, we've seen situations where that company now has to lay off people, the stock price goes down, and now you might even get laid off. So it's the worst of both case scenarios. The other mistake on the other side of the fence is when a qualifying event happens. Either you retire or you're terminated or the company gets bought out. So you have to decide what to do with that, with your ESOP program, those shares. We've seen some people just take a distribution. Not always the best case, because depending on your age, etc., it could be taxes and a penalty on top of that, which we try to avoid at any cost possible. Or they'll take the shares, if the ESOP plan allows it, and stay non-diversified by still having too many shares, over concentration in their portfolio. Of course, whenever I tell someone it makes sense to work with a financial advisor, it sounds biased, but objectively speaking, typically, ESOP decisions of this nature happen during what are called qualifying events. So either you're retiring, or you were terminated, or the company was acquired, which typically leads to a termination of a plan, and you have to move those monies or roll it over into another plan, such as an IRA. So an advisor can sit down during this time of flux, if you will, where there's a lot of moving parts in your life, and say, okay, let's look at all the decisions and how each decision, each choice that you have with your ESOP plan allow you to maximize or optimize your situation, whether it's diversifying your portfolio, minimizing the risk depending on your risk tolerance, okay, or optimizing, your tax situation based on where you are in life, what your income situation looks like, etc. So a financial advisor can sit down with you, look at the various factors, and see how you best optimize a distribution or rollover of an ESOP plan. I hope this helps. And if you have any further questions, please feel free to reach out. Thank you and have a great day.